Work done by US firm research affiliates expects economic growth in the US to be just 1/3 of the 3.3% it has averaged since 1950. Some of the factors contributing to this lower forecast are a slower population growth, a declining labour absorption rate and more muted productivity gains. So what effect will this have on the world economy and South Africa in particular? Andrew Newell from Cannon Asset Managers joins us to answer these questions. It's a big order in terms of getting to all those questions. But let's start with an overriding theme on the economics front from Cannon Asset Managers, and perhaps that's with the influence that the global environment, the developed world, is going to have on the emerging market story.
Warren, there's two parts. So the world average will be robust, it will continue growing, but to come back to the advanced or developed world that you refer to, the research affiliates research is quite sound, and in the order of 1% growth for the US is certainly not what we've become used to. That theme permeates through to Europe, the UK, Japan, the whole developed world really. And taking that in conjunction with a developing or a dynamic world where demand and growth, we think, will remain intact, you get an aggregate figure which is satisfactory. So we're not heading for doom and gloom across the world, but it is made up of two baskets: a very sluggish developed world and a dynamic set of countries which actually looks pretty decent.
Well, the fact that it's not doom and gloom is a good place to start, I think, Warren.
Yes, Andrew, I mean, our economy has been aligned with the UK and the US. You know, it's much broadly aligned with those than some of the emerging economies, although that's changing quite rapidly. You know, what does it mean for us? Does it mean that we almost have to orient our businesses more towards developing economies? And for that we need a government that goes out and signs trade agreements with the likes of Brazil and India and China and Indonesia and those places? Or, you know, what do we take from this? Do we just expect lower economic growth globally now for a number of years?
Yeah, there are two parts to your question, so I'll give you two parts to my answer. We do remain closely tied to the advanced world, and that's not something that will change tomorrow, unfortunately. So as much as they face these headwinds and these obstacles which they need to try and overcome, and we don't see them doing that soon, that is going to hamper our economic advancement. The second part to your question is we are increasingly linked to the emerging world, which is good, because as I've already suggested, we think that their growth will remain intact, and if we are exporting and trading with them more and more, that in turn will impact our economy positively. So by way of example, it's not just China, Brazil, India, they are very important, but our own sub-Saharan Africa, some of them are very close to us, our immediate neighbours, but a little bit further north as well. There our exports have increased 20% over the last year. Now that's positive. Is it enough? No. Is it a step in the right direction? And as a trend, absolutely, it's great.
I know Adrian Seville, your CIO, has been following the African story very closely of late and looking at the growth numbers coming out of the continent. The stat that I put to President Zuma recently in Davos was that we're sitting at a 5.3% projected growth rate for the African continent as per the African Development Bank's projections. If you strip South Africa out of that equation, you're actually looking at a 6% growth rate. So South Africa being the drag right now, is that going to be the story going forward?
Are we going to be negative and pull the 6 down to 5.3? I want to say no, but those are the numbers they've put forward, then so be it. The fact remains that will we get to 5.3 as a continental average? Highly unlikely. We throw around numbers of 5 and 6 that we need. Absolutely, that is what we need, but we don't think we'll get there in the near future. 2.5 is probably a more realistic
continental
outcome.
Growth at 2.5.
No, sorry,
You're talking about South Africa now.
In other words, our contribution to the continental 5.3 is less than average, and so by inference it will
actually pull it down. So if you took it out because of its quantum,
the 5.3 should lift
should lift to 6%, which is the equation.
Andrew, I just wanted to ask, I mean, do you think we're doing well enough positioning South Africa as the gateway to Africa? Because it seems from our discussions with portfolio managers on the show and decision makers is that many investors kind of see Africa now as a three-hub continent, where you've got the West Africa, East Africa and Kenya, and then South Africa serving this sort of SADC area. You know, is there anything we can do to sort of enhance South Africa's profile better, or create a better environment from which businesses can launch onto the continent?
Yeah, so you started your question by saying, are we doing enough? My short answer, no, we're not. The sort of general mindset has for a long time been that South Africa is the gateway into Africa, and I think that's becoming less and less relevant. And you can look at this in different ways. Nigeria as the hub of the West.
170 million consumer story surely has got to take over as the gateway.
Well, you need to work hard to overcome that as a 50 million economy. So we're a third of the size population-wise. East Africa, a wonderful growth story, huge infrastructure investment spending going on. Kenya building what they call Silicon Savannah, so our answer to California. Those are the types of things we need to be doing, and recent news that our conversion in terms of internet and broadband, that doesn't fill me with glee. Those are the types of things we need to get right. And
our labour competitiveness.
And our labour competitiveness must increase as well. All of these things can be debated at great length. We obviously don't have the luxury of that tonight, but these things need to be addressed in a far more efficient way. Today, for instance, we hear that education is now called an essential part of our policy. That's great, and I think that's a wonderful step in the right direction.
But it's been a long time coming.
It has been a long time coming.
Policy a long time ago.
As South Africans, we have habits of wonderful plans and strategies. This needs to be implemented. We need some execution of this good idea.
So let's take that macro environment and drill down now into an investment play for 2013. Obviously, January is behind us. Where do you see the most value as a house right now?
At the asset class level, we favour equities. Drilling down into our equity markets, we see two distinct pockets of attraction and one area where we are quite cautious. The area that we are cautious is generally large industrial companies, industrial oriented, so not just factories and warehouses, but I'm speaking specifically about cash retailers and globally exposed firms, Richemont, British American Tobacco, SAB Miller and the like. The places we find good value is in the more domestically oriented industrials. Generally they are in the mid and small cap part of our market. So
but let's be honest, Andrew, you guys love small and mid caps, don't you? It's one of your...
Like fat tail, because you can get into it.
It's one of those areas that you go looking for bargains.
That is true, but I'd put a sort of a caveat to that. It's not that we like mid and small caps. We like them now because that's where the value almost exclusively resides. And so if you look at a Canon portfolio, you will see an overwhelming number of mid and small caps. So your comment is true, but for a different reason, if that's fair to say. So those stocks we find great value, and we've seen some nice runs over the last couple of months. Believe it or not, some of the construction stocks have sat up. We've waited some time for that. We've discussed those companies before. But not just construction, related firms like ELB Bateman, Hudeco, which supplies into the construction and the mining industry as well. And then the resources sector quite broadly is undervalued, which is not surprising given the stresses that the sector has faced, both from concerns about global growth, and we've addressed that to some point now, but also some of the labour unrest, political uncertainty.
So what will be the value or the value unlock here for the resources? You've mentioned labour, you've mentioned the global economic picture. Are those the two factors that need to turn around aggressively for us to see some momentum in these resource stocks?
Yeah, I think those are the two key ones. So in terms of labour disruptions and social tensions or stresses, we need policy clarity, whatever form that might take. It might be to say that the platinum companies go ahead with retrenchments, or they don't, but just make a decision on which one it is. From a global growth perspective, more visibility in demand and what they want. Now, for instance, over the last couple of weeks, iron ore prices, as you know, have hit all-time highs. That's a nice barometer. Perhaps that's the first step in understanding where global growth might be headed. It looks robust. That's obviously one component, but it is certainly an early indication.
Just bringing that back to the resources, you mentioned obviously improved commodity prices help every resource company, but with regards to the costs, we've got Eskom that are pitching for 16% year-on-year increases out to 2018. We've got labour unions which we're unsure of what sort of wage settlements we can expect going forward as an investor.
Yeah.
So when you say that they are cheap, you've got to be fairly sure that there's some containment in costs. Is there any distinction between any of the resource companies in terms of their cost base that you can make as an investor and say these guys will operate more cheaper than others, or is it pretty much across the board?
I think across the board resources are attractive. I suppose the starting point is a lot of these cost inputs are priced in, and we think excessively so. So it's not necessarily about saying Eskom's increases of 16% will be 16 or they will be 12 or there might be 20 something. I think all resource companies have had these factored into their earnings, and some have just been really hard hit. So they're all attractive. I think what you want to do is find those companies that have been harder hit, and this might become subjective, but which ones unfairly so. And there are different ways you can look at it. What is their own long-term average price multiple, how they're done relative to peers.
Now you're talking about the resource block. You know,
yes.
I'm going to push you further. I want specific stocks here.
That's fine.
Let's chat about AngloAmerican. I know it's been a play of Canon Asset Managers for some time. The recent news flow, Mark Cutifani taking over as the CEO from Cynthia Carroll. Are you looking for value unlock? Have you changed your position in AngloAmerican?
No, we haven't. And yes, we are looking for value unlock. I think Anglo's is quite a good example of a company that has been oversold. It doesn't change the fact that they have disappointed shareholders by the ongoing delays in Ministerial specifically, and the budget being nudged higher and higher and higher. We are told...
So shareholders are at the end of their tether on this one?
I think so, and I think the price has been pushed down appropriately. So where to from here? That's probably the more important question. And I think in Mark Cutifani, you've got a good operational guy in AngloAmerican. And can he suddenly turn it around tomorrow? No, I don't think anyone can suddenly turn around a business like that. But what we are getting is better visibility in terms of they are more and more confident that the project will come on stream. The budget, the over budget has been priced in, so that's in the numbers. And assuming that they are now able to commit or adhere to the time frame of getting the production on stream, I think we'll get better sense of how much volume is actually coming out. Now the numbers are very attractive. Take them with a pinch of salt, given that many investors are sort of once bitten, twice shy.
We're out of time. Final 10-second statement on AngloAmerican, and we leave it there.
Excellent quality, diversified portfolio, and value will be unlocked.